You know exactly what you should do. Stick to your plan, respect your stop loss, and let your winners run. Yet the moment the market moves against you, a wave of anxiety, frustration, or greed washes over you, and you break every rule. This isn't a moral failure. It's a breakdown of your emotional control system. The truth is, you can't eliminate emotions in trading, but you can absolutely control their destructive power. Emotional control isn't about being stoic. It's about building a systematic framework that prevents your feelings from ever reaching the execution button. This video is going to give you the 3 non-negotiable rules for emotional control that separate the professional operators from the retail gamblers. These rules will transform your emotional responses forever, neutralizing the fear and greed that kills your account. The first rule of emotional control happens before you even click the mouse. You must establish the pre-trade shield by ruthlessly focusing only on the factors you can control. Here's a lie you tell yourself: I need to predict the market to feel safe. The psychological truth is, uncertainty is the primary source of anxiety. When you try to predict the market, an uncontrollable variable, you invite fear and stress. When the market defies your prediction, your anxiety explodes into panic. Professional traders understand that their profit doesn't come from predicting, it comes from reacting perfectly to the unpredictable. The fix is the 3 certainties. Before every trade, you must lock in 3 certainties. If these 3 are not confirmed, you do not trade. This is your shield against future emotional collapse. 1. Risk certainty. You must know the exact dollar amount you are willing to lose, and it must be so small that losing it causes 0 emotional pain. If you feel stressed just placing the stop, the position is too large. The 1% rule is the maximum emotional defense. 2. Context certainty. You must confirm the high time frame direction, the trend, and the market state, ranging or trending. This prevents you from taking low-probability trades based on impulse. 3. State certainty. You must check your mental state. If you are hungry, tired, angry, or distracted, your emotional defenses are already compromised. Trading requires 100% of your mental capital. If you don't have it, you close the charts. By controlling these 3 variables, you enter the market with a foundation of certainty, eliminating the vulnerability that fear exploits. The second rule of emotional control happens during the trade. You must install an action barrier that prevents your hand from touching the mouse based on fear or greed. Here's a lie you tell yourself: I must constantly monitor the trade to protect my money. The psychological truth is, constant monitoring amplifies both fear and greed. Every single candle becomes a potential trigger for an impulsive action that violates your original, logical plan. Greed spikes when the price is moving quickly in your favor, compelling you to add more or remove your take profit. Fear spikes when the price is moving against you, compelling you to exit before the stop loss. Both are destructive. Here's the fix: the automation and higher time frame rule. You must automate the painful parts of the trade to remove the emotional variable. Actionable tool. After your entry, immediately set your stop loss and take profit levels. Then, walk away from the specific time frame you executed on, e.g., the 5-minute chart. Your only allowed monitoring is on the next 2 higher time frames, e.g., the 1-hour or 4-hour chart. By automating your exit points, you prevent fear from cutting the loss early and greed from holding a winning trade into a reversal. By moving to a higher time frame, you filter out the noise, meaning the small, panicked pullbacks that would normally trigger your anxiety now look like minor adjustments. You are trading the structure, not the noise. You replace the emotional surge of fear and greed with the mechanical certainty of the automated order.
The third rule of emotional control happens after the trade is closed. You must establish a complete post-trade reset to prevent the results of one trade from contaminating the next. Here's a lie you tell yourself: A winning trade proves I'm brilliant. A losing trade proves I'm a failure. The psychological truth is, tying your self-worth to your P&L is the single fastest way to destroy emotional consistency. It causes greed after a win, overconfidence, and fear or revenge after a loss, shame. A successful trader knows that any single outcome is random. Their job is not to win, but to execute perfectly. Here's the fix: the execution scorecard. You must stop judging the trade's outcome and start judging your execution. After every trade, you must score your performance on a simple binary scale. A, perfect execution, you followed every rule. B, flawed execution, you broke one or more rules. If the trade was a loss, but your execution was perfect, you mark it as a success and you celebrate the discipline. If the trade was a win, but your execution was flawed, you moved your stop or entered early, you mark it as a failure and you penalize yourself. This could be closing the charts for the rest of the day or donating $50 to charity. By making execution your only measure of success, you detach your ego from the P&L. You are rewarding discipline, which is controllable, and punishing indiscipline, which is destructive. This system guarantees that the results of the past trade never contaminate the integrity of the next one. I want to share a story from early in my career, back when I thought I was already a disciplined trader. I call this the $800 setup. It was a Tuesday morning. I took a textbook short trade on euro. The trade looked perfect, but the market reversed sharply and stopped me out for a loss of exactly $400. Annoying, but acceptable. It was my 1% risk rule. 2 hours later, I saw the exact same setup on the 15-minute chart, but this time it felt different. It felt like a guaranteed winner. I thought, the market faked me out earlier. This is the real move. If I take this trade and recover the $400, I'll be back to break even for the day. That, right there, was the whisper of revenge. My trading plan had a rule that I had just installed. The maximum daily loss is 2%. $800 on my account size then. I had already lost $400. That meant I had exactly $400 left to risk for the day. But the revenge voice was loud. If you risk $800 on this one trade, you'll recover the entire day and be ahead. The setup was so beautiful, and the temptation to risk double my normal size was overwhelming. My finger was hovering over the buy button, which I had just mentally changed to revenge. I took a deep breath and physically removed my hand from the mouse. I stood up and forced myself to perform the post-trade reset from Rule 3. I opened my execution scorecard and asked, Question 1, is this revenge trading? Yes, the intent is driven by the desire to get back the money. Question 2, does this violate Rule 1, risk certainty? Yes, risking $800 is a double-sized position and violates the 1% per trade rule. Because the answer was yes to both, my system dictated that I could not take the trade. I closed the charts, walked away, and felt absolutely furious. I felt weak for not pulling the trigger. The next day, I pulled up the chart from Tuesday. That guaranteed beautiful setup I almost risked double on. It was the final trap. It went sideways for an hour before collapsing completely, wiping out the entire $800 that I was tempted to risk. If I had allowed my emotions, my desire for revenge, and my feeling of certainty to take over, I would have triggered my maximum daily loss limit, ruined my account history, and started my Wednesday with crippling psychological debt. The most profitable action I took that entire week was the simple act of walking away from a tempting trade. Your rule set is not a suggestion, it is a shield. It is the only thing that will save you from yourself when the market whispers that lie of guaranteed recovery. All right, let's wrap up the 3 non-negotiable rules for emotional control. You now know how to combat emotion using 1. The pre-trade shield, controlling the controllables; 2. The action barrier, trading probability, not outcome; and 3. The post-trade reset, separating the operator from the results. Here's a key takeaway. Emotional control isn't about fighting your feelings. It's about building a robust mechanical system that shields your trading execution from those feelings. Stop trying to conquer your mind and start automating your discipline. If this framework is the edge you needed to control your emotions in trading, hit the like button and subscribe. See you in the next one.